Today on the Altimetry Authority show, calls for the U.S. being in a bubble. A bear market is about to come. The stock market's at the highest levels ever are based on bad data with bad measurements. And when you use good measurements and use good data, you get a totally different picture of what's going on.
And check out two companies that we think are a classic example of how as reported PEs get it all wrong today on the Altimetry Authority.
Let's talk earnings and favorite pastime.
So let me just say, earnings
Wall Street
That's 2.5x.
because their compensation goes up.
Wall Street's wrong again.
There's been a lot of talk about the U.S. stock market being in a bubble, and invariably, every time they bring it up, they talk about this CAPE PE, the Shiller CAPE PE that's been making its rounds yet again, and it's unfortunate because I don't know how this chart still has gotten any use, except that people who want to say that we're in a bubble continue to show this PE ratio. They say it's cyclically adjusted. There's a little bit of an inflation adjustment that they do. Otherwise, it's just basically a 10-year average rolling PE since 1871. And they argue that, look at this number, it is at a 39 times multiple. It is higher than just before the 1929 stock market crash and the Great Depression that followed. It's almost as high as the dot-com quote-unquote bubble in 2000. That's their argument. The problem is, this assumes that earnings, because it is a price to earnings multiple that they're doing, it assumes that earnings has been calculated consistently over the last 100-something years, which it hasn't. So while Shiller, has gotten a Nobel Prize in real estate, nobody would give him a prize in accounting nor in valuation, given the nonsense of this chart. The problem is people keep showing the chart because they keep saying, oh, look, we're in a bubble. See, we're in a bubble. We can show it to you, when in fact, their data is just bad. And so we question this highly because as Ben Graham is the professor who taught Warren Buffett, Charlie Munger, Bill Ruane at the Sequoia Fund, Walter J. Schloss, Knapp and Anderson and Tweety Brown. I could go on and on with the people that took his courses, right, at Columbia, I'm talking 70 plus years ago, and then went on to become multimillionaires and billionaires because of learning what he taught. And he said, by the way, net earnings is often wrong. And he said, you have to adjust earnings, right? It may be necessary, he said at the time. I'll say today, it is 100% a necessity. And the reason is you can't rely on these as-reported earnings, frankly, or assets or liabilities or debts. Anything GAAP, generally accepted accounting principle-based metrics, are just wrong, and Shiller is using that in his chart. Now, let me just explain. How much has earnings changed as a calculation from the 80s to, I don't even have to go back to the 1950s or 1960s, just in the last 30, 40 years, it's changed radically. One is merger and acquisition accounting is different. One, there's a lot more mergers and acquisitions today than there were 40, 50 years ago because there's a lot more companies available, a lot more even private businesses. And when companies buy other companies, it used to be you didn't expense the cost of the company being bought. Meaning if there's goodwill and the company, quote unquote, paid more than the assets on the books, you never expense that number. Today you expense it. I'm not saying it's wrong to expense it. I'm saying that it wasn't expensed before and it is being expensed now, which makes the earnings number calculation lower as a calculation than it would have been if you just kept consumable accounting. Same with inflation. The way inflation is captured, the accountants have been back and forth on this fair value or not fair value or not. And what you end up with is the accountants have built a financial statement today that does not capture inflation the way it should be, and it has led to an earnings number that is lower than you would have calculated back in the 1980s or before. Pensions. You did not have, when I studied for the accounting in the late 1980s, we did not have pension accounting, meaning if a company had pension expenses, those expenses were off balance sheet. The debt of the pension was off balance sheet, and so we didn't expense it. Today you are. I'm not saying, again, it's wrong to expense it. I'm saying you just weren't before. So to use a PE, a price to earnings ratio, back in the 1980s or the 2000s and compare it to today is just ridiculous. I could go on and on. Stock cost expenses like stock options. There's a lot more stock options being used today. That creates an expense that did not exist when companies issued stock to management in the 1980s or before. And R&D, there's a lot more R&D, research and development, and today the U.S. still expenses at 100%. It doesn't treat it as an investment. It's a big error it is wrong. What the CPAs are doing in the financial statements under generally accepted accounting principles is absolutely wrong, and yet they continue to do this. So what is the result of all these down arrows in their earnings? Well, even Seth Klarman, because if you don't want to use Ben Graham from 7 years ago, Seth Klarman, one of the greatest investors at Baupost Group, one of the greatest investors of the last 30, 40 years, right, in his book, Margin of Safety, he said, analysis of reported earnings it absolutely does mislead investors as to the real profitability of business, and it does it down. So just as a little AI exercise, we took ChatGPT and we said, ChatGPT, I have a question. Given all the changes in accounting rules over the last 40, 50, 60 years, what percentage is the Shiller CAPE price to earnings multiple overstating or understating today's PE? Then ChatGPT even would come back and say by 30 to 40%, meaning it's overstating it because the E is understated relative to history, meaning it is not a consistent benchmark. And so we put that together, we end up with a PE ratio of 39 that even ChatGPT would say is probably 40% too high. Well, if you knock 40% off that number, what do you get? Well, we don't have to do that. We don't have to knock the 40% off because we actually built a database where we calculate the uniform PE using the same earnings calculation over the last 40, 50 plus years. I'm showing the last 20 here, right, from 2006 to 2025. And I'm showing the multiple that you get when you keep a consistent earnings calculation over time and you don't let it go up and down just because an accounting rule changes. You keep the accounting rules the same, which, by the way, does mean expensing a lot of things, but doing that over history, not just recently. And what you get, let me just zoom in from 2020, is a multiple today that, yes, is about 24 and a half times higher, 2 to 3, over what we saw in 2020. And that was a pandemic year. So if 2020 was a pandemic year and we finished with a 22 times multiple, I don't think that given the boom in AI and the health of the U.S. economy, that 24.7 is a very high multiple. And this is bottoms up. This is where we take 4,000 companies and we add up together and we then calculate the PE. We don't argue with the price. The price is the price. But the earnings number, right, has to be calculated consistently. And when you do that, you end up with a PE that is truly about 40% less, as ChatGPT would have guessed, about 40% less than what the Shiller CAPE model is calculating, which means we are not in a crazy bubble. We are not in some multiple of earnings that's insane. We're actually in a very, very healthy bull market that's being driven by, well, why don't we take a look at, right, what's driving up U.S. equities? Because it's not the multiple. The multiple is only driving up U.S. equities by a couple of clicks from 22 to 24, 25 times. What's driving up U.S. equities is uniform economic profit. So if you calculate economic profit for companies using uniform earnings over a long history of time, you actually get this long chart going back 20 plus years. And let me zoom in again on just the last 5 years, right? The last 6 years. The reason why the stock market's up so much is because from 2020, where it had a 22 times multiple on, call it $800 billion of economic profit, we're now looking at more than double. And people would say, but wait a second, the U.S. stock market doesn't price on this year's earnings, it prices on a forward basis. Well, we did that too. So we took analyst estimates, we took forecasts. These aren't our forecasts. This is where we took the market's analyst forecasts and said, what are they looking for 2026 and what would that be in uniform earnings? And that number is close to $2 trillion. So when people are saying, why is the stock market up so much? It's not because it's in a bubble. It's not because of a price to earnings ratio that has gotten too crazy high. It's because actual corporate profits are up from $800 billion to what we're looking at is something like $2 trillion of economic profit based on next year, or already at 1.6 trillion, best guess for this year. That's what's driving the stock market. That's why it's not in a bubble. And as long as the earnings and the investment cycle continues, which it is quarter by quarter, we're looking at a bull market that has a long, long life, and it's nowhere near the bubble and crazy bear market status that it's like 1929 or 2000. That's nonsense. This is more like 96, 97, 98.
I mean, Joel, to your point, from 2023 to 2026 forecast, that's almost 50% growth. So everybody just put that in perspective. In a 3-year period, you're talking about 50% growth in earnings. And, right, if you keep on having that growth, not obviously, basically 15% a year, which is what you need for 50% growth in 3 years, but, something that is high single digits, low double digits, which is what we're forecasting, no wonder the market keeps on going higher and higher. And Joel, I've got a question for you before we get into anything else. does the market normally fall because of high valuations, CAPE or otherwise? I don't remember. I can't think of an example of a time that the market has just fallen because of high valuations. Can you?
High multiples tend to go higher until something like a credit crisis occurs, a corporate credit crisis or something else, which is what you had clearly in the 1930s. The Great Depression was bankruptcies and all over the place. Corporate credit crisis, you see bankruptcies. We don't see those kinds of bankruptcies. Someone mentioned, but a couple of banks just went under recently. I'm like, do you know how many banks went under in the year 1991 during that recession? 1,000. 1,000 U.S. banks went under. So telling me that 2 banks went under and then reminding us of Silicon Valley Bank from like years ago and saying, see, it's happening, that is not what happened when you have bankruptcies like this. Financial services tend to be and are right now very, very strong. Not to mention companies across the board that are benefiting from AI in such big ways that we're measuring and seeing when we use a equal measuring stick over time. You're seeing unbelievable economic profit and a frankly low multiple on earnings, relatively speaking.
Exactly. No, and I mean everybody, right? So of course you're probably wondering, so what are some examples that you can actually give us of companies that you might actually be able to say this about? That you might be able to say, hey, is this actually something really concrete, or is this just a really fun thing that you guys are talking about? Well, we have actually a handful of companies that are great examples of this, everyone. There's 2 that we want to highlight that are companies that we think are really, really compelling. And part of the reason we think they're so compelling is the market is misunderstanding just how expensive, or in reality, not expensive they are. The first company is Mirion Technologies, MIR. This company makes all of the key equipment you need to be able to monitor a nuclear power plant, to be able to maintain a nuclear power plant, to be able to deactivate a nuclear power plant, all the stuff that you need. They basically are one of the most important suppliers on. And so you think about that, of course, as we are in the midst of a huge, massive amount of earnings growth because of an AI boom that needs to have power, including nuclear power, everybody, you'd expect that this company would have a really, really high PE. And yet, Joel, right, which is what the as-reported metrics show. The as-reported metrics show like a 40 times PE. But Joel, what do the uniform metrics say?
So when you're looking at, it's kind of similar to what the CAPE Shiller PE screws up on, which is GAAP accounting would suggest that this company is trading at a price-to-earnings ratio of 40 times approximately, when in reality, it's about 25. Well, 25, even then people say, so first off, it's 25 times. That is not 40 times, so it's a lot cheaper. But on top of that, 25 times could be an expensive multiple if earnings is growing at 0. Right? If earnings has no growth, then yes, I would agree 25 times is a high multiple. But 25 times when earnings are growing as fast as Mirion Technologies earnings should be growing, because everyone knows the world needs more nuclear, it needs a lot more electricity. The only way to get that over time, right, is going to be partly from gas, but heavily over the long term from nuclear, and this company is going to benefit massively from it. 25 times is not expensive when you have that kind of potential earnings growth. It just isn't. And it certainly isn't 40 times, which is just silly, right? That's just a bad math, and it's a bad calculation. As any great investor worth their salt would tell you, you can't trust the GAAP accounting-based as-reported PE. That's what the orange bar is. The blue bar is the real PE under uniform, and it's about 25 times, just slightly a click above where the U.S. stock market is right now. Yet for a company with its growth potential, this is a really interesting idea.
Exactly. And the next company that we also think is interesting is Twilio. So Twilio, everybody, is a great example of a company that is unlocking tremendous amount of earnings thanks to AI. It is an AI user. Whereas using AI, what it does, Twilio, just for those of you who don't know, is they make basically the software, the solutions and everything for people to be able to run customer service centers, for people to be able to manage their interactions with their customers, with their prospects and everything else. And on an as-reported basis, it looks like this company had PEs as high as 35 times in 2023, when, by the way, Twilio is up a lot from 2023. And even now, it looks like it has a 25 times PE. In reality, those blue bars, which are the real uniform accounting PE for this, they're sub 20 times. They're like 15 times. And when we show you just how profitable Twilio is on a uniform accounting basis and how it's growing, you'll see why we think this is a really interesting company. So what this is here...
It's another...
Yeah, go ahead, Joel. Yep.
It's another example, just like the stock market, that the stock market is up right? They're saying it's up on some crazy multiple when in fact that just is not the case. And Twilio is another example that you'd say, well, maybe it's trading at 25, 26 times multiple. In fact, it's around 16, 17, 18 times where it has been for the last years, which means the stock is not up because of a multiple issue. The stock is up like the stock market because earnings are up, which Rob is about to show.
Exactly. And so these blue bars here, these are the real, true profitability return on assets of Twilio when we clean it up and all the adjustments that we make that, right, Joel, you were talking about that CAPE doesn't make, to see what the real profitability is of this business. And return on assets has been rising over the last few years from basically 0 to almost 20% now. Well, these light blue bars are what Wall Street analysts, when we take their estimates, right, Goldman Sachs, JP Morgan, everybody else, and we push them through our framework and we say, what is Wall Street forecasting this company's profitability to be for the next 2 years? Wall Street is forecasting that return on assets are going to keep on rising. Well, these last 3 white bars, these are at a $15 billion market cap at a $100 give or take stock price for Twilio, what the market is pricing Twilio to do. Right? Think of this as the line. When this line is below what you think that the company can do, that means the company's cheap. When it's above what you think the company can do when the white bars are high, that means the company's expensive. Right now, as this company that's not trading at a 25 times, it's trading at a 15 times PE, the market's expecting return on assets to crater when we know that everything this company is doing from an AI solution to unlock the benefits of his business, return on assets is going to stay really strong for a while. And that's what's so interesting and a thing that you wouldn't see if you were using the as reported PEs to think this company would screen out as a high valuation company. And so everybody,
Rob,
go Joel.
One of the common themes that we've been talking about with their subscribers has been this over focus by the market on AI companies, and what they're missing is the AI enablers and the AI enabled. And when you start looking at those, that's not just your traditional AI chip company. We're looking at all kinds of firms that are benefiting from being either AI enabled or AI enablers, and that's where we're finding some of the greatest, most interesting doubles and triples in stock picks over the last 6-7 months.
Exactly. And so everybody, if you want to see more companies like this, or quite frankly, if you disagree with Joel and I and you think this market is massively overvalued because CAPE is right, contrary to where the stock market has gone, well, CAPE has been screaming bloody murder, feel free to drop that into the comments. We always love a debate and we'll circle back up. And also hit the like and subscribe button and come back for next time on Altimetry Authority. Thanks so much, everybody.
Thanks, everyone.